Realize. All right. Over here, checking all the streams. Let's make sure it is working. That one's working. That one's working. All right. So I think everything is up. You can get all these so I'm getting feedback. Let's take that and put it in the LinkedIn group. And let's see. Share to, nope, that's not how that's going to work. Tax mastery. And we're getting there. Still have 3 minutes. And okay, so I'm just going to assume that that's going to continue to work without any trouble. Excuse me. I don't know if it's a good assumption or not, but that's what I'm going to assume. Okay. And then at the top of the hour, we will get started. Also have to remember to actually record the presentation. Mhm. Each is there. I should start doing those little blog type posts on YouTube. That would be smart. And then, because the show after this is the Monster Memory Show, and we get all the Splinterlands people in for that one. But oh, Serena's here. All right, let's bring Serena on as a panelist. There
Hello.
she is. Hey there. How's it going?
Good, good.
We are about, so we're already live, but I'm about to start recording and all that.
Okay, sounds good.
And I already checked the streams. Everything seems to be working.
Okay.
So I'm just going to assume that they will continue to work.
Yes. Everything looks good.
Uh, oh, there she is. All righty. So we are going to go. Oh, we're already live, but we're going to start recording. Can I find the button? We're going to start recording now. Hey, everybody. It is 6 o'clock, at least where I am. It's Tuesday, which means it is time for Tech Sherpa Live. And this week is office hours. This is just open Q&A where you can ask whatever you like. You know, I will say that I will take any question. I'm not qualified to answer any question, but anything tax related, I'm good. If it's outside that meaning of life, I'm happy to take a stab at it. But your mileage may vary. So yeah, so office hours is just like, once upon a time, I was a graduate student and I had to have office hours as a TA. So, just people come by and ask questions. And that's kind of how this whole thing works. So we have questions from the live audience. I see one already in from Eros. Um, and we've got questions that have come in from clients and people we've talked to over the past couple of weeks. So I actually just got off a call with somebody, and we'll get into some of the questions there that were brought up because it's actually pretty important as far as like what to do when your relationship with a tax person goes bad. So
Mhm.
so that is
Yes.
something. Unfortunately, we are on the well. I mean, fortunately for us because we pick up more clients, but unfortunately for the people involved, that can lead to a lot of stress and problems. All right. So let's get into it. So who am I? Who are we? We're Tech Sherpa. I'm Neal, founder of Tech Sherpa. Serena here is our ops manager. She keeps the ship running. And I do, these days, my job is mostly strategy, where, we will work on clients' positions and figure out what's the best way to do things. And then things like this, where, I'm out there, I'm the pretty face. So, done over 50,000 tax returns, $250,000 worth of payments processed, billions of dollars worth of client earnings, all of that kind of stuff. Our site, taxsherpa.com, you can find all the important things there. You can book an appointment. You can read our blog. Published a new blog yesterday, I think it was yesterday or today. So, we try to keep that up to date. Um, so be sure to check that out. This is me. Um, so my story of how I got into the tax world is kind of an unusual one. I went to school for engineering, not for accountancy, which is how most people get into the tax world. So I went to school for engineering, got all the way through my senior year, was interning out in Texas in Austin, and then I realized that I didn't want to do this anymore. So I can actually pinpoint the moment. So I was working for AMD, which is Intel's competitor to make computer chips, and I happened to be there during the time that the first 1 gigahertz processor was released. It was a big deal. Stock shot up to like $60 or something. All of my employee stock purchase plan shares were locked up for a year, so I couldn't do anything on the pump. But it was nice to see, at least. And then towards the end of the term, around May or so, we had a company award ceremony. And, Joe, he got 3 patents. Let's give him his plaque. Let's give him a hand. He's a great company man, etc. And, the ceremony was, I don't know, an hour long, something like that. And the VP of, can't remember which VP it was. One of the VPs was doing the presentation. And the last one said, this is a real special award. Bob here, he had a 2 week European vacation booked with his family, approved months ahead of time, paid for the whole works. And when it came to crunch time and we had to get product shipped, he canceled his plans and came into work like a good company man. And let's give him a hand. Here's a plaque. And people are clapping. And it was at that moment that I realized I'm never going to be able to work in a corporate environment. So just not going to fit my personality. And that's not bashing on anybody who does, but it's just for me, not going to work. So thus began my entrepreneurial journey. I read Rich Dad Poor Dad somewhere around there, maybe a couple of years later, and that really kind of lit a fire under me. Did a whole bunch of stuff, mostly failures, but you know, survived long enough. And then in 2007, I started getting letters from the IRS saying that I owed them $1.3 million. And so that was my entry into the tax world. It's quite a brutal slap in the face. But uh, so I've been through that whole journey where if you get a letter or letters, they'll send you repeated letters. If you ignore all those and the number's big enough, they will start sending you certified mail letters where you have to sign for them. And if you ignore all those, you'll start getting phone calls from revenue agents. And if you ignore those, they'll start going after whatever they can find: bank accounts, jobs, um, If you have high price assets like cars and boats and that kind of thing, they'll go after those. So I went through that whole thing. And in fixing my own problems, this took years, by the way, this whole process. So it takes years to start and then it takes years to go through. So it took a lot of willpower on my part to not fix my problem for that long. But I finally, when they started garnishing my wages from my job, I was tutoring high school kids at the time. Then that really got my attention because I couldn't buy food, so that was a problem. And so in fixing my own problem, I ended up hooking up with this former Wall Street tax attorney, and he helped me fix my problems. I ended up paying zero of that 1.3 million. And he was in a phase in his business where he needed lots of help. So he had the tax knowledge, but he didn't know how to run a business. So he was struggling with growth. And I had, 10 years of entrepreneurial experience, some good, some bad. And I took all those lessons and I applied them to his business. And we were able to triple his business over a couple of years, which was, pretty incredible. And then, I started doing tax returns in 2011 under his guidance. And I went through a very old school kind of apprenticeship rather than, taking courses in college. But, it turns out I'm the better for it. So what I didn't know at that time was that the things he was doing was not the things that other people do in the tax world. So because he came from this Wall Street tax planning background, they used to deal with the New York stock specialists, the people who administered the markets. Um, it was always strategy. It was always what can we do? It was always how can we improve this position for a client? And that could be a client making 20 grand. It could be a client making 2 million. It's just, different strategies apply at different scales for different things. So, so that's how I learned, and that's how I did, 50,000 tax returns, over the past, decade plus on, billions of dollars worth of revenue. And, we save clients 20, $30 million a year. And I parlayed that into Tax Sherpa. So Tax Sherpa that I started in 2019, which really got started in 2020 though, it was founded for the people like me. Because what happens is in the tax world, like I'm in these mastermind groups with, tax advisory services and all this kind of stuff. And the push from the coaches and the gurus and everything is always, find high earning clients, charge them more. That's basically the business model. And I have seen people charge $150,000 just for a tax return. And this was a corporate tax return, but still, it's just a tax return. And it's not even to not even to figure out what the numbers are to go into the tax return. It's just take the numbers you already have, put them in the form. And that's, a little bit crazy in my opinion. But, if the company's willing and able to pay it, then so be it. So that's one end of the spectrum. The other end of the spectrum is your corner tax prep place, your H&R Blocks, your Liberty Taxes, Jackson Hewitt, well, there's a bunch of them. And, those people are, let's call them minimally trained. And I could go hour after hour of stories that I've seen of people bringing in old tax returns from these places. But basically, they're okay if you have a very simple tax situation. If you have a W-2, and that's it, then you can go to them. That's okay. Even then, sometimes they screw it up, but I'll try to be charitable. I'm in a good mood today. But it's the people in the middle, the people that are, are self-employed or have a small business or freelancers or somewhere in there, and they can't afford crazy fees for a tax return. And if they go to the corner tax person, they just end up getting screwed because that person doesn't know how to handle business taxes and how to do strategy or planning or anything. And those are my people. So if you also can't hold a job because you're unemployable, because you can't have people telling you what to do, then, then you're gonna fit in with Tax Sherpa. So obviously we handle other people as well, but that's really my core tribe just because of my own life experience there. Um, so that's kind of who we are and what it is we do. We have a whole team. Serena's our ops manager. We've got a tax team, bookkeeping team, and we can handle kind of soup to nuts. But that's what we do. We help those people in those more advanced situations figure out how to save tons of money on their taxes. So this is office hours. So let's get into the questions. And before we get into your questions, I have a question for you. And my question for you is, what is the root problem with overpaying on your taxes? So you should take a second and think about that and say, okay, let's just say you overpaid by $20,000. this year or last year. Most people are done filing 2022s at this point. So what's the real problem with that? You already paid it. Life has gone on. Okay. So here's my problem with it. It's wasting 20% of your life. So, most people, at least the people that we talk to, are usually paying somewhere between 20 and 40% when you factor in everything. When you factor in federal income tax, payroll tax, self-employment tax, additional Medicare tax, state income taxes, all that stuff. It ends up somewhere in that 40 to 40% range. And, what is 20%? So a lot of times we'll come in and we'll create a blueprint for somebody, and the blueprint is the method by which we apply tax strategy of various kinds in order to reduce the tax liability. So the the net result is we'll save people on average between 20 and 50,000. Obviously, numbers are dependent. Everybody's situation is unique, but kind of that's our bulk of what we see. And so if we take your tax rate from, let's say, just take the middle, take it from 30% down to 20%, which is pretty common, we just saved you 20% of your life. And, so if you were paying 30% all in, 30% of 365 is 109 days. 109 days that you're working for the government, essentially, various governments. Could be state, could be local, could be federal. And if we take it down to 10%, that saves you 74 days during the course of the year. Now, I know that's might be oversimplified, but on a work day, how much of your time is really focused on yourself? Relatively little, So, if you have a job that requires going somewhere, going to an office or something, there's waking up, there's getting ready, there's getting in the car or the train or whatever you do. There's getting there. Then there's the actual work. Then there's the lunch break, which you're still pretty much at work. Then, there's the afternoon or evening, and then there's the commute home, and then there's the decompressing, and then there's the getting ready for tomorrow. So, if you're awake 16, 18 hours a day, and you spend, 8, 9 hours like being paid, that's not real. That's not reality, because you have 12 hours all in for all the things that go into doing the job that you have. And so how much quality time do you have with yourself, with your family, with whatever it is you want to do, with your hobbies? Work days are work days, right? That's why they're called work days. And so I've come to realize, and this is actually a recent realization for myself, that what we really do beyond the money, and the money's great, and I think that the money is better served in your pocket, doing whatever you want with it, reinvesting in your business, going on vacation, going to Vegas, whatever you want to do is better than giving it to the government. I truly believe that. But on top of that, even more important is the time that you get back, and that's time that you could do anything you want, so because you're able to use that time for yourself rather than being forced to work for it, for the feds. So that's my question and my answer. That's the critical problem with overpaying on your taxes. It's just bad for the world, basically, and bad for you in particular. But I also have the answer to all tax questions, and the answer is it depends.
It depends.
It depends, because it does. And accountants and lawyers are famous for saying this. And it really does depend, because everything is dependent upon what's called facts and circumstances. Or you'll hear lawyers talk about a fact pattern. So it depends on what the situation is, how it applies to you and your particular situation. My favorite example is how if $100 gets put in your bank account, how much tax do you owe on that? And the answer is, it depends. Was that income? Does that income have offsetting expenses? Was it a gift? Was it a loan? Was it, randomly dropped from the sky like the COVID stimulus checks were? So it depends. And so just knowing a number does not tell you anything about what the actual impact is, because it depends on the situation. So that's the short answer to everybody's questions, but I know people want more. So we'll get into it. And I see Eros. Sarita, can you see the chat? I don't know if you're on this or not.
So nope, I'm not seeing anything.
Okay, so we've got Eros. Eros is asking, "Hey Neal, do you do personal crypto taxes? I have most of my transactions in Coinly, but I've recently came to the point of entering my Splinterlands transactions, and so I'm overwhelmed." Yeah, it is overwhelming. So let me give everybody a little bit of background on crypto taxes. So back in, I think it was 2013, the IRS published a document where they established their position on cryptocurrency, and they said this is property. Now, I happen to agree with them that it is property, um, but that creates a whole bunch of complicated scenarios that happen as a result. So if you have a let's say you're on Coinbase and you buy Bitcoin and then you sell Bitcoin. It acts like property. It's a capital gain or capital loss, just like if you had a stock or a bond or if you had, if you were in the trade of cars, like you bought a car and then you sold it, like a collector's item or something. So that part works okay. Um, and there's been no legislation or anything on this. This is just the IRS stuck a flag in the sand and they said, we're doing it this way. I'm like, okay. we're more or less in agreement with that. And um, what none of that accounts for is more complicated scenarios and situations that come about uh, in the non-centralized exchange world. So in DeFi or in GameFi. So Splinterlands is a GameFi environment where people play a game, they're rewarded with cryptocurrencies of various kinds, and the game is played using non-fungible tokens. So it gets complicated, and um, then it also gets into the question of what do you actually have and what do you not have, because some of the opinions that have come out since the 2013 paper has basically said that you have to do a look through analysis, and what that means is you have to look through the tokens, especially with regard to NFTs, non-fungible tokens, and you have to figure out what is actually going on. So in Splinterlands, you have to actually look at what is happening. So I'm of the position, and this is a position, a defensible position, that staking assets by definition makes them out of your control. And in the tax world, there is this concept of dominion and control, where if you have dominion and control over an asset, then you own it for constructive purposes. If you don't have dominion and control, then you don't. And my opinion is that in many of these DeFi cases, you lose dominion and control when things are staked in a system. So what that means is that I mean, and again, it depends on how you are administering your various systems and what it is that what event happens first, what event happens second. But it gets complicated. So um, so you might have a sale, you might have a no income, you might have a recognizable income event. It all depends on what it is that you're doing. So as far as how we handle crypto taxes, we'll give you advice. We're not combing through your transactions because it's just an insane number of things, and we don't have time for that. The amount we would have to charge to do that kind of thing is just astronomical. Eros, if you want to set up an appointment, go to taxsherpa.com, click the book an appointment link, and that'll put you on Serena's calendar. If it's crypto specific, I'll drop in as well just to kind of see what's going on, and then we will figure out what is appropriate in your situation, because maybe you have income, maybe you don't, maybe you have losses, maybe you don't. It's all dependent. Like it says on the screen, it depends. But that is the difficulty of dealing with a tax a tax concept that doesn't actually apply to the things that we're doing, because you can do things with cryptocurrency that you can't do with regular property, and that creates these vague issues. um, but yeah, that's the question number one. Um, and Serena, what else do we have on the list? I know we compiled a couple before we went live here.
Yes, yes. So we have a question from our one of our clients is, are tax payments business expenses?
Aha. So would it be too short to say it depends?
Uh, it does depend.
It does depend. All right. So tax payments being deductible or a business expense or not. So sometimes yes, sometimes no. So what happens is that, you know, if you have, let's just take the personal example first. So let's say you work for another company, you get a W-2, you make 100 grand. Very clean, very simple. The tax that you owe on that does not become a deduction to yourself on that 100,000. That's just an additional amount that you owe. And they're just taking it off the top, essentially. And, various calculations go into that as far as how much becomes taxable and all that kind of stuff that goes into a tax return. But the tax itself is not a deduction for your personal. However, if you have a state income tax, that might be a deduction. It depends on the amount. It depends on if you hit the caps, the $10,000 SALT, state and local tax limit imposed by the Tax Cut and Jobs Act. It depends on whether you're able to itemize other deductions or not, and that depends on your filing status. So state and local taxes can be a deduction, maybe, uh, if you satisfy the various conditions on your personal taxes. On most states, if that becomes a deduction, they will then add that back to the state income, and then the state level will tax you on the total, including the amount you paid to the state. So it starts to get weird already. On the business case, now most businesses are flow throughs. They're either Schedule C's, 1065, 1120S. These are all flow through in that they the income or the net income from the business flows through into your personal tax return and it becomes included as part of your taxable income. So in those cases, the most common scenario we see is that we do S corporation, so 1120S. So the company will never pay a federal tax, and so the income flows through to your personal. It gets included plus or minus whatever it is, and you'll pay your federal individual income tax on whatever that number is. And let me just ban somebody real quick. Okay, there's that. And then and then so the federal tax is not a deduction for the business there. Some states have an entity level tax. So like DC has an excise tax, Washington State has an excise tax, Illinois has a I forget what they call it, but it's a $2,000 tax. Um, and then in Tennessee, they have an external tax like that. So in those cases, just like on the personal, the state income tax become a deduction for the federal purposes and may or may not be added back on the state level, just depending on the state and how that works out. And so those kind of complications, then flow through into the personal and gets included with your personal federal tax and personal state tax. Then, just to add another layer of complication, so in the Tax Cut and Jobs Act, which was Trump's tax reform back in 2017, they imposed this $10,000 limit as far as state and local taxes. So what some states have done, and it's a handful, I think they're up to like 12 or something. What some states have done is like, well, okay, so we can't get around that directly, but our response to that is that we'll allow a pass-through entity tax payment. So what that does is on the state level, let's say you have $100,000 of income from a New Jersey company, and that passes through to your personal. So in New Jersey, you can make a pass-through election where you could say, okay, I know I'm going to owe to New Jersey based on this $100,000. And so what I'm going to do is I'm going to have the company pay New Jersey on my behalf, knowing that the liability is going to flow through to me, but the company's making the payment. And there was some back and forth between the IRS and everything, and they ended up resolving this in favor of that tax being paid by the company as a deductible expense for the company in those states where they have that. So so in some states that is a strategy, and the and the pass-through entity tax paid by the company on behalf of the shareholder is a deductible expense. So that's in a case where it is a deduction. Other taxes, which are deductible, are like payroll taxes are a deduction, at least the employer portion. Um, sales taxes, most people do wrong, honestly, because you're supposed to just exclude it, both revenue and expense side. But if you do include it in the revenue, then you do include the expense on the expense side. So, depends on which tax, depends on the situation, depends on the state. And I will tell you that penalties are not going to be deductible for you. So, if that becomes an issue, then you're stuck. Um, you have to pay tax on the income and pay the penalty out of your proceeds. So sometimes yes, sometimes no is the answer to that one. But it gets complicated. Is that's the bottom line.
Right,
And
right.
and just to wrap that one up, so the most of the provisions of the Tax Cut and Jobs Act are ending in 2025. So into 2026 they'll be, revamped or sunsetting, going back to the old way. And that is a very open question as to what is Congress going to do, because they can always change their mind, pass a new law. But for now, it looks like that the pass-through entity tax idea will kind of cease to exist in 2026.
Okay. And then we have another question from a client. And they heard that the Augusta strategy was thrown out in court. Neil, is this true?
That is not true.
Okay, good. That's a good thing for us.
So yeah, Augusta is one of our favorite strategies. Um, so what happens is, so the Augusta plan or the Augusta strategy or the master strategy, it goes by a couple different terms. What happened was, there's in Augusta, Georgia, which is down the road from me, the um, the guys who live around the golf course in big fancy houses, they wanted to rent out their houses during the golf tournament, the Masters, and not pay taxes. So they lobbied Congress, and that's now a thing. So under Section 280 AG, you can rent your primary dwelling up to 14 days a year and exclude that rental income from your taxable income. So it's just like it never happened. Just cash money in your pocket, the end. So, we can take advantage of this by having management meetings with your business. That's kind of the basics. So what happened was that there was a court case, I don't know, a year ago, something like that, where somebody went to court and their version of the Augusta strategy got thrown out because they were just excessive about it. They picked crazy numbers, and the court said, "Hey, you could have gone to all these other places. It would have been way cheaper. So your deduction here is not valid because you did it strictly for the tax benefits rather than for business purposes." So the strategy itself still perfectly valid. You just have to follow the rules. You gotta figure out what a real price is and don't go crazy with it. So, it's like most things. Another set of things that has gotten um, into into trouble areas and become red flags. People always ask about red flags. Uh, here are red flags. Home office deductions, red flag because people abuse it. Um, Huge mileage deductions is a red flag because people abuse it. And I've seen people bring in some crazy numbers. Um, One of Serena's favorites, fuel tax credits, giant red flag because people
Giant red
abuse them.
flag. Yes.
Um, what are some other red flags? Say home office, uh, fuel credit, the excessive Schedule C losses. Those are a big
Oh,
one.
definitely. Yes,
Yeah.
definitely.
And Conservation easements are almost an automatic audit. Conservation easement is where you take a piece of property and you donate it to a conservation entity, and it's set aside for non-development. And it's basically a charitable contribution. And people abuse them, crazy numbers, and so basically every one of those gets audited. And it's a perfectly valid thing to do, but you have to use real numbers. You have to have appraisals. You have to look at what is actually going on instead of just making up your own pie in the sky kind of stuff. Um, Conservation easements. Oh, another one that's been abused and caused people to have problems is captive insurance. So, captive insurance is actually a super interesting idea where um, you have your operating company and it has some kind of risk. So we talk to a lot of e-commerce people, and they have giant risks. Like if Amazon bans them or if Google changes their algorithm. I was just talking to somebody earlier. They were doing some e-commerce on Facebook. Facebook changed the algorithm and their business just died. Just it was doing okay and then zero. So that's a real business risk, and that's a business risk you cannot buy insurance for on the open market. You can't go to State Farm or Geico or whatever and get a policy for that. Even business specialized business insurers don't insure that kind of risk. So what captive insurance does is you basically form your own insurance company, and whether you do direct insurance or reinsurance, there's subtleties to that, but you form your own insurance company, and now the operating company will pay a premium for a policy uh, to cover that specific risk that they can't buy anywhere else. And so it becomes an insurance expense to the operating company. But because of special rules around insurance companies, that money coming into the insurance company is not income because they are going to owe that back when a claim is paid. So the insurance company takes that money, they invest it. The investment returns are taxable to the insurance company, but that's a percentage of a percentage over the years rather than the whole amount. And so that insurance company is building up value, depending on what the actuaries say, is mathematically valid. And then they, hopefully someday never have to pay back. But if they do, then they cash out their investments and they pay off the claim. So you get a deduction on the operating company and you get not income on the insurance company. So that's where you get the benefit because you are subtracting on one side and then not adding it back. And so this is a strategy that gained in popularity for a number of years. And uh, like so many things, people abused it. And so it went on what the IRS calls the dirty dozen list. Every year they publish a list of 12 strategies that they don't like. Not that they're invalid, they just don't like them, because people
Right.
abuse them. So so if you're out there and you're listening and you're thinking about doing any of these things, captive insurance, conservation easements, home office deductions, fuel tax credits, you got to make sure that you're actually following the rules, that you have your
Mhm.
documentation, that you are not, picking numbers out of the thin air that are not justifiable. And if you do that, you still might get audited, but you can win. So
Right.
that's the whole thing. Um, and then and at some point you got to make a business decision as to whether this is worth doing or not, knowing the potential headaches it can bring. Because when it comes to audits, the process is the punishment. I mean, yeah, there's the money aspect, but really the people who fight audits and have somebody who is not willing to work with them, it can be extremely painful. So I've had clients who were 100% in the right. I'm thinking of one in particular. Um, they questioned the real estate professional status, and this was somebody who was operating Airbnbs full time. I mean, it's a job. They were spending the hours and everything. They had the logbooks and everything, and it was basically a $50,000 audit. And uh, so there was not a husband and wife, but a boyfriend and girlfriend. And it was the girlfriend that ended up getting audited, and the boyfriend, who was kind of like managing their finances or whatever, his business was blowing up separate from the real estate stuff. And, we sat down and we talked about it. I said, okay, you're going to have to do this, that, and the other. You're going to have to, compile your logs. You're going to have to send them over. You're going to have to show the tie-ins, what in the tax business or the accounting business, we call this tick and tie. where we match up different the transactions and list them out and show how they went into the tax return and all that kind of stuff. And you are right, you will eventually win. It will be a battle.
Mhm.
And he made the decision to, the amount of time I would spend on this, I'll lose more than $50,000 in my other business. So he just decided to pay it, even though he was right, because he didn't want to go through the process. So that's always a decision that you have to make on a case by case basis. So many people, they hear about these lawsuits where the companies just settle, even though they know it's frivolous and they know that this is nonsense. But the amount of cost that would be to actually litigate this thing is way more than if we just paid it. And the people doing these attacks know that. So that's kind of their whole strategy. But it is what it is. So ideally, if you're doing a high risk strategy, you want to back it up, from A to Z. Uh, but you may want to employ that strategy or not. And when we talk to clients about different strategies, we will talk about audit risks and those kind of things. So if you do this, that, and the other, you'll lower your audit risk. If you do this other thing, you'll raise your audit risk. So there's decisions to be made as to what you want to do, what you don't want to do. We got a question from Mango Wambo. Do you have any advice on how to make small company less dependent on its owner? I'm looking for ways to disengage from daily operations. That is a great question, Mango. Um, so yeah, I do have advice. So, in Tax Sherpa, we're going through this where, we're building out the team and, I'm still leading strategy, but I'm definitely not, doing tax returns like I was. Part of that is just from health. I'm not able to, but part of it is by design as well. So yeah, there's a number of different approaches to doing this, and I think the one that's actually easiest is you have to define exactly what it is that's happening in your business. So there's general categories, right? So there's marketing, there's sales, there's onboarding, there's fulfillment, there's customer service, there's finance, invoicing, collections, accounts payable, accounts receivable. There's all these different things. And what you want to do is you want to have a matrix of, the job on one end and then the person responsible on the other end. And so you'll have a grid. And then you just fill out where you are currently. So each job is assigned to a person, or maybe multiple people, maybe it's a team, depending on how complicated your business is. And just get your current state and figure out who is doing what, as all the things that, from customer is born to, we have, we have operations, we have revenue, we have expenses, all those kinds of things. So kind of in the business life cycle from birth to death of a particular stream of income. And so map all that out. And then on a either monthly or quarterly basis, start moving and figure out what are the things that are in your business that only you can do. So like with Tax Sherpa, I'm the Sherpa. It's
Yeah.
basically how it's worked out. I have tried kind of avoiding that as well, but that has not worked. So I'm here, and this is the part, my really extensive experience in a wide variety of areas really allows me to get insight into a lot of different things in the tax world. So that's the unique thing that I have to keep doing for Tax Sherpa. When it comes to a more basic tax strategy, we're training people up internally, and eventually they will take over those roles. When it comes to marketing and sales and fulfillment, that's pretty much off my plate already, but it's a process. So Serena's nodding because she's doing all, like, if you book a call on taxsherpa.com, you're going to talk to Serena, and
Yes.
she's fantastic, and she'll diagnose your issues and she'll bring it back to the team, and we'll go over all the things that are going on and figure out the plan. Um, but so defining those roles and then getting the roles that you don't have to be involved in off your plate, and um, that can be accomplished in a couple different ways. So the first question you always want to ask about a particular task or a particular role is, does this need to be done at all? Can we just delete this or trash it? Um, And it could be that you're getting in your own way with doing things a certain way. So that's the first thing to look at. Because if you can cut something, that's always going to be the easiest, most cost effective thing to do. If you decide that you can't trash it and this thing has to be done, then who should do it? And maybe that person's on your team already, maybe they're not. Um, but you want to have a goal as far as who should be doing what. And then over time you have to start shifting those things over. So where people get into problem is in if they just abandon the business. So it's like, yeah, I hired a consultant and now I'm doing nothing, right? So that
Right.
that that does not work. So anytime you shift a responsibility from one person to another, there's going to be a transition period between where you first train that person on how to do that thing. So let's say it is something simple like paying the internet bill, right? So that comes fairly automatically. If you're at one level, you just automate it and you just delete that responsibility. You put it on auto pay. On another level, maybe you have a contract. We've got a client who has nurses working for him, and he created this whole tablet system that they got from I think it was T-Mobile or AT&T or one of those. And it's actually a complicated process to pay the internet bill because there's 300 different devices and they have to account for the usage on all the different ones, and there's rebates involved. It's a whole thing. um, so that process has to be trained for somebody during the training period. You can't just leave them on their own. You gotta train them. You gotta check them. You can say, okay, now do this, and then you say, did they do that? Okay, yes. Did they do it right? Okay, yes. And then we can move on. And over 3 to 6 months, really, that's kind of how long it takes for somebody to really solidify a business activity. Then you step back more and more and more, and eventually you just get reports, and you say, okay, were these things done? Yes, great, let's move on. And so, how many things you can take off your plate is going to depend on your business. How many people are available to do the things that you can do is going to depend on your business. One of the difficulties with entrepreneur-led businesses is the E-Myth. So if you haven't read them, there's a series of books by Michael Gerber called The E-Myth. There's The E-Myth Revisited and The E-Myth Mastery or something like that. I don't know. Michael Gerber, E-Myth, search it, it'll come up. Um, and the E-Myth in his formulation is the entrepreneur myth. And the entrepreneur myth is that because I'm good at doing a thing, then I can run a business doing that thing. So like in Tax Sherpa, because I'm good at tax returns means I can run a business that does tax returns. And that the one thing does not follow from the other. So I know plenty of great people, plenty of great technical people who cannot operate a business at all. It's a different set of skills. So, but what ends up happening is because most people who go into business for themselves and who start up, a business that ends up hiring people and has a team, then they they're really good at that thing. Like I'm really good at taxes. Um, but the people you bring on don't have your depth of experience. If they did, they would have started their own companies, right? So you know where you as one person as the entrepreneur leader might have been able to do 50 different tasks. There's not one other person out there that's going to be able to do those same 50. So you have to accept that, and then understand people's aptitudes and interests and just capabilities as far as how much they can do of those different things. So hiring people gets expensive quickly, and for most companies, payroll is the number one expense. And it's because of that function. Because when you start bringing in outside help, they are just 99% of the time not going to do all the different things that make up your unique skill set. And so there's going to be redundancy there, and that's going to be part of the cost. But you get back your time and gain the ability to scale out more. So it is a trade-off, and those first few are by far the hardest. That's where most people get stuck, and you have to design your business in a way that it can afford that overhead of just having those people involved, and the training and upskilling that has to happen in order for them to take over that responsibility. So I know that's kind of general, but without knowing exactly going into your business, that's kind of the general strategy. There's a guy I knew through a mastermind named Scott Fritz, Fritz. He's out of I think he lives in Vegas now, but he had I think he still owns a PEO where it's a professional employment organization where if you're a company and you want to hire people, but you don't want to do all the HR stuff, you use a PEO. So he was one of those companies, and he did this to himself, and he wrote a book called is it the 4 Hour Year or something like that, where it's kind of a takeoff of Tim Ferriss's thing, where he did this process through his own business and was able to reduce his workload from a full-time, more than full-time kind of operation to 4 hours a year. And he did it by systematically outsourcing the things that he didn't need to do. And it turns out he doesn't need to do anything in his business. He was able to replace his talent entirely, which is great. And he would just come in like once a quarter or something and have a meeting, and that would be it. So that's the general idea. But a small company, you're always going to be, involved because of just because of the size, and you're not going to be able to replace all of your skills and needs in the company with other people. But how much and where that split is, it depends.
It depends.
It depends.
So Neil, I have another question for you
Okay.
from a client, and they asked, what makes an owner's draw, an owner's distribution, and a owner's salary different from
Ooh,
one another?
that is a great question. All right. So I'll start off with it depends, and it depends on what kind of business structure you have. So if you're a Schedule C business, that means you're a disregarded entity, either you're a sole proprietorship, or a DBA, or a disregarded LLC. So if you're one of those, there is no distinction. And the business is you, you are the business. So any money that's in a business account, that's your money. You could do whatever you want with it. There's no concept of distributions or basis or anything like this. Once your business graduates to a higher level, as either as a partnership or as an S corporation, then we get into where these things start to matter. So a company makes money, and let's just say it's an S corporation. Um, Company makes money, it spends money, has expenses, and then at the end of that process, it has a net income or a net loss. So let's just say net income for simplicity. So just to put numbers to an example, let's say S corporation has $50,000 net income after expenses. So that $50,000 flows through onto the owner's tax returns. It could be one owner, it could be many owners. Whatever their fractional percentage is, that is what flows through onto their tax returns. Now, if there's an associated $50,000 there, then that $50,000 can be distributed to the owners, based on their ownership share, and that's a distribution. So an S corp distributing profit is a non-taxable event. Uh, it gets into weirdness when the amount distributed is not is greater than the amount of profit and investment that the owner has. So this can get into real estate. So if you're in a syndication, let's say, and there's 100 owners, and everybody puts in 10 grand, and then the property is bought, it's improved, it's rented, and then later on it's refinanced, and over the couple of years it has gone up in value. So now everybody, so they take the refinance money and they distribute a bunch of funds to the owners. So we put in 10, a couple of years later we get back 15. Okay, now the first 10 is a distribution against my basis. So that's the investment that the owner made, and so that part is tax free. The 5,000 extra is what's called excess distribution. And that actually acts like a capital gain. So it's going to be, taxed at long-term capital gains rates. So that's one item. An owner's salary. So S corporations, when profits flow through into the owner's, tax return, it avoids self-employment tax. So partnerships carry self-employment tax, S corporations don't. And so that's why there's a reasonable compensation rule in S corporations, but not on partnerships. And so because the the S corporation profit allows you to avoid having to pay Social Security tax and Medicare tax and unemployment tax, uh, they implemented this rule called the reasonable compensation rule. So the owner's comp is the compensation that the company pays to the owner for the services provided by the owner. Now, this gets fuzzy real fast. But basically, it pays a wage. So a W-2 is issued and payroll taxes are applied. And, you know, the if you look at the court history, the reasonable compensation things that go through court are usually, like everything else, they're excessive kind of things. They're like, oh, company made $200,000. I paid myself $24,000. That's reasonable. It's like, well, is it? you know, uh, and really it hinges around Social Security tax because the income tax remains the same, uh, more or less. But Social Security tax is the biggest chunk of that self-employment tax. It's 12.9 out of the 15.3. So when these things go through court cases, the IRS always comes back and says, well, you should have paid yourself. They pick a number, and it's always like right near the maximum for Social Security. Because every year they raise the cap. That's actually going to be one of the next great tax hikes is Social Security tax. But but so because you're allowed to avoid that with S corporation profits, they counteract that with the reasonable compensation rule. And um, just as a quick aside, the reasonable compensation, like what makes it reasonable, basically you want to tally up what it is that you actually do on a day-to-day basis. So if you're like Mango and you totally outsource yourself and you're not actually doing anything for the business, then there is no reasonable compensation. You're just an owner, right? But if you're like most small business people, then you're going to have owner shares, profit portions, and you're going to have how much work did I actually do for the business? Was I out there marketing? Was I doing sales? Was I doing fulfillment? Was I doing, this, that, and the other? And, you figure out in your market for a business of your type, and there are reports you can get to calculate all these kinds of things. And I spend 3 hours doing this and 2 hours doing that and 5 hours doing this other thing and 12 hours doing the third or the fourth thing. And you figure out what a blended average would be to actually hire out those jobs, and you pay yourself that. And that's an approach that has been tested and succeeded in court as far as defining what is reasonable. So that's the reasonable comp or owner's comp portion. And then what was the third one, Serena? I think you had three terms.
Yes, so it was the owner's draw, owner's distribution, and then the owner's salary.
Okay, owner's draw. So owner's draw is more or less the same term as a distribution.
Mhm.
There can be instances in partnerships where you have a guaranteed payment. Sometimes people call that an owner's draw. So a guaranteed payment is just a replacement for salary. It carries the same payroll tax kind of implications, and it's basically just a flat rate that the partnership is going to pay towards one or more of the owners, and sometimes they'll book that as a draw. Um, but otherwise, yeah, it's just the same as a distribution.
Okay. And then I know we only have about 6 minutes left,
Yeah,
but another question I have for you, Neil, is
I thought we were gonna close early today, but apparently not.
no. So, it's almost December 31st, and
It is.
what I've been hearing from clients is if, is there enough time to create strategies or to be proactive because, you only have a few days left in December
Yeah,
uh, when
that's
it comes
a
to
great
strategizing.
question. So the short answer, besides it depends, is yes.
Yes, yes, yes,
So
yes.
there is time to do a lot of things, not everything. So there have been strategies we've had to, say, well, next year we can do this, but we don't have time to get these things implemented. But there's a lot of strategies you can still do. So don't let the calendar dictate your aversion to planning for the end of the year. So I know we're in constant communication with a bunch of clients right now. We're trying
Yeah.
to tie up loose ends, and we're trying to put some things into place for other clients. So yeah, it's still a very active time to be doing all your tax strategy. And but yeah, there are a few things that you're just out of time to do. So there's that. Um, so we got 5 minutes left. I'm gonna cut off the questions here,
Perfect.
and because I did want to go over just a couple of things, a couple of next steps. Here's what we want you to do. We've got a free LinkedIn group that we're starting. It's called Tactical Advice Explored, TAX. That was my clever uh, invention. And this is where we're so like the recording of this, the slide deck, and everything that'll be posted in the LinkedIn group. You just go to taxsherpa.com/group. That'll redirect you to LinkedIn. You can join there. And every week we do one of these. Now, next week we're off because break between Christmas and New Year's, and so there won't be one this upcoming week. But every other Tuesday, um, you just go to taxsherpa.com/live, and I'll update that redirect to always go to the next event. And those are the two things that we want you to do. And if you have more questions, you post them in the tax group, Tactical Advice Explored, and Small Business Mastery is the subtitle. And we'll talk about it there. And that those are going to be for general questions. So like Mango's question about getting to be less dependent on the owner. That's a perfect question for the tax group, where we can share ideas and go over all those different things. I can give you links to all the things I talked about with the E-Myth and the Scott Fritz's book. I have a copy on a USB drive somewhere, but they gave it to me at a conference. Um, but yeah, so that's what we want to see you doing next. And otherwise, we'll see you over the next. Oh, there's our little header thing. We'll see you on the next one, which is going to be 2 weeks from now, which is the 2nd, I think. Is that
Yep.
right?
Hmm.
Yeah. So January 2nd will be the next live event. And I don't know if we'll do so normally we alternate. We do one office hours and then one like strategic level presentation. And, so normally next week would be the strategic level, but I don't know if we should push that out or just go back to office hours and keep our regular schedule. I don't know. Serena, what do you think?
I think we should do Q&A when we come back
Okay.
on
That works for
Tuesday.
me.
Yeah. Yeah, works for me too.
All right. So January 2nd will be office hours again. And, bring all your questions. And we'll see you next time.